Greetings and welcome to another episode of At Astra Kansas Money Talk podcast. And I'm Joe Blubaugh, joined by Mark Johnson and Bob Schwartz. They are the brains behind Bob Schwartz Financial with offices in Silver Lake and Victoria, Kansas. And of course, if you want more information about the services that they provide, you can always go to bobschwartzfinancial.com. If you're joining us on YouTube, we would ask that you give us a thumbs up and subscribe, so that way you'll know when we have new episodes that are being published. And also, if you're listening to us on your favorite podcast provider, give us a rating. It helps other folks find the podcast, learn more about investing money and money in Kansas. So with that, gentlemen, I hope you've had a great holiday season so far. As we record this podcast, we are in that time where Thanksgiving is done and Christmas is approaching quickly, and maybe more importantly, the new year is approaching quickly. And it's that time of the season where people feel a little bit more charitable. So we wanted to take a little bit of time today and talk about charitable giving, and specifically maybe as we approach that December 31st cutoff, for ways to do it more efficiently with your taxes. And even if you catch this episode after the end of the year, there hopefully will be some information in here that will help you moving forward to find ways to be a little bit more efficient in your giving. So with that, let's talk a little bit about some of the ways that people can give and be more tax efficient with their giving. One thing that has changed over the last several years is we used to have a standard deduction that was much smaller than it is today with our taxes, and a lot of people would itemize. And with that, they would include their charitable giving inside those itemized tax deductions. With the larger standard deduction, a lot of times that standard deduction is much bigger than itemized deductions. So what are some of the ways that people can potentially give but still be able to use that giving as to take a little bit of deduction off their taxes?
You want me to go?
Yeah, sure, why not?
Sure, Joe. It's several things happened over the last 30 years to really change the giving outlook. It used to be a marital deduction was $7,500 not that many years ago, and interest rates were high on mortgages. And so if you gave some money to your church each year, you had some health care expenses, and you had quite a bit of mortgage insurance or mortgage interest that you were paying. That was all deductible. And let's say you had $15,000 worth of deductions, so every year you'd get a bang of $7,500, and let's say that happened to be what you were giving to the church. So that worked out that's how you were getting to write that off. Okay, spring forward, and we've got a whole generation that have homes at 3%. The interest that they're paying each year is much smaller than it was 30 years ago, and the deduction that we get is $25,000. So that $25,000, we get that every year, no matter whether we're giving or not.
And that's actually gone up a little bit. It's actually $29,200 for a married couple in 2024.
Correct. That's another, I think, a good thing that Congress did is they put that with the CPI. And so, yeah, $29,200. So a lot of times a family's paying $4,000 in interest. They're given, $500 a month to a charity. They're given $1,000 a year to another. They're giving $500 a month to their church, for instance, $1,000 a year to another charity, and they're not getting any advantage out of that tax-wise because of the $29,200. So what we see younger people doing, and when I say younger people, I mean under 70 and a half, is creating what are called donor-advised funds. And you'll hear us refer to those as DAF, and I apologize for that because we are always good at using acronyms. But a donor-advised fund, for instance, a client can put, or someone can put $100,000, say, into a donor-advised fund. The money goes in there, they get the write-off on it the year they do it. So 2024, they did it this year. They get to take that deduction off, but then they can take and give that money over the next 4 or 5 years. They've received that deduction, and of course each year they're going to get the 29.2 because that's every year from the government. So it's a more efficient way to give for folks that have assets that they can put into a donor advised fund.
So that would be for those that are charitably inclined, a way to really just bundle all their several years worth of charitable giving into one tax year, claim it that year, and then they can distribute those funds as long, anytime they want to at that point. Now, I believe, and please correct me if I'm wrong, but once that money goes into that donor advised fund, it has to be given to some kind of a charity. It can't be taken back out. Is that correct?
You can't call up and say, "Hey, I want it back." Yeah,
Right.
Yeah. So when, it's a gift, but they're fantastic. They really are. And there's a lot of places. I think we're going to talk about that in a minute. But there's a lot of ways for people that have the capacity to do it, for donor advised funds to just be a great legal tax break for people in a higher income bracket.
And then do your funds grow in the DAF? Do they collect interest or?
Okay, so most of our clients so far, because these are like the early years of the 529, people, we're still getting familiar with them. Most people are putting them in money market. Yeah. So they're earning 4.5% on it for the charity that they're going to give it to. But yes, Mark and Joe and everybody out there, you can invest those assets. They can be invested as aggressively or non-aggressively as the person wants.
Okay, so it'd be just like any other investment in a 529 or in a IRA of some kind. You can invest in the market.
Right.
You can put it in CDs.
You can go buy an IRA at the bank in a CD. You can come to a brokerage house and buy it. You can go to investment, a fiduciary like ourselves and have the money invested. It's just like that. Yeah, you can do anything you want.
Now, you mentioned something when you were talking. You mentioned a date, 70 and a half, and I think it's important that we maybe talk about why that particular age is so important, because at 70 and a half, something else happens that really is more of a recent thing: qualified charitable distribution. Yep. Mark, what is a QCD, as they're called, and how can that help, and why is 70 and a half such an important age on that?
Yeah, so you have to be over 70 and a half to do that because of your required minimum distribution that takes place in, remind me now, what
73.
Year? 73.
73 to 75.
When they started it, the required minimum distribution started at 70 and a half, and so in the Secure Act, they made 70 and a half for the qualified charitable distributions. And they haven't kept it up with which is good. Good.
Yeah.
I mean, that's good for us as consumers.
Yeah, and so QCDs are what, you're going to hear another acronym. It's probably annoying, but Qualified Charitable Distribution is what that stands for. But it allows you to directly transfer from your IRA to a charity without being taxed as income for that year.
Okay, so this is a distribution but not directly to the owner of that account, but to a charity.
Yep.
Correct?
Yep, and then it's not taxed as income for you, which is pretty powerful.
Correct.
Yeah, and can satisfy your RMD.
So RMD, required minimum distribution, and for those that don't know what that is just it's when the government forces you to start taking money out of your retirement account. And we kind of mentioned 73, and they've started to raise the age. So as the younger you are, my age is 75, your age is 75. Bob, I think
I'm already taken.
You're already taken your, yes. So, but the powerful thing about this is that this can satisfy that required minimum distribution. So instead of having to take out a distribution and get taxed on it, you can take that amount and send it directly to a charity. Am I understanding that correctly?
Yep. Up to 100,000.
Up to 100,000
per person.
Per person per year.
So, if Mark, if I can jump in here for a second, we have been doing this for these have been out for 3 or 4 years now. we have clients that there's something called IRMA, IRMMA, which is a surcharge on your income, it's a Medicare surcharge pegged towards how much income you have. Most Kansans, and this is wonderful about us folks, most Kansans do not look forward to the RMDs, the required minimum distributions, because they have enough money. And so consequently, we had clients taking the required minimum distributions. It was throwing them into a higher tax or into a Medicare surcharge, which is steep. And now those folks can take, and that doesn't show up as income. So we have clients that actually take their whole required minimum distribution and they give it to their church or to a school, and you can give it multiple places. I mean, otherwise it doesn't have to be. We have one client I know that has 16 different places, but also that client. So let's say the client has to pull out. I'm going to use even numbers. $100,000. We talk to their tax, or we have them talk to their tax planner, their tax preparer. Sorry, I didn't mean to say planner, preparer, and we find out where their next bump is on their taxes. So let's say they're supposed to pull out $100,000, and their next tax bracket's in $57,000. Well, they'll take the distribution of $57,000 because it's at the same tax bracket they're at, and it won't. Otherwise, it's not going to affect IRMA, the Medicare surcharge. The rest of it they'll go ahead and give away, because they have a giving heart, but also because it makes a great difference for them tax-wise. So Uncle Sam, if we'll use it, and if we have quite a bit of money in our IRAs, we'll give it, and our 401ks, et cetera, they will give us opportunities to be tax efficient with our giving and with our income.
Very good. And I had to look it up because IRMA is one of those acronyms that I can never remember what it stands for, but it's Income Related Monthly Adjustment Amount. But just like you said, it's a surcharge, and if you read between the lines, it's a tax on Medicare for those. There's different brackets. We could do a whole show on IRMA. We don't want to get into it here,
Right.
but it is something that needs to be taken into consideration as with a lot of different parts of planning, but specifically with giving, that's an area that
we can help clients control it, by giving. And now the one thing about it, you can't put a qualified charitable distribution into a donor advised fund. And I couldn't understand that for a while until I started thinking about it. And if they allowed that, you'd be getting a double break.
Gotcha.
on it. So it has to go straight to a qualified charitable institution.
Okay. And another thing that I think that is critically important here, and people might not think about this, is it has to be a direct payment from the IRA, the 401k, to the charity. It cannot be a distribution to the individual and then the individual writes a check to the charity. No. Then you're going to get taxed as normal.
It's going to show as an income on your income tax. You're going to get a 1099 that it was income. And yes,
Yeah, and so that does take some planning. So
yeah, well, you lose the 25,000. You're 29.2. Yeah.
Yeah, and so if you're doing it yourself, if you don't have a financial advisor or someone, like, you need to make sure when you're taking those distributions, like, you understand how to transfer that straight to a charity, not to yourself first. So that's something to make sure to talk. If you're not sure how to do, make sure you talk to someone that can help you do that.
Okay. And so the other thing to keep in mind, you've already mentioned, you have to be at least 70 and a half to take advantage of a qualified charitable distribution. So anybody younger than that, they can't do it that way. And once again, if your QCD either partially or fully can satisfy your R&D that year, so it's very, very powerful. Okay, so I think we've talked about that quite a bit, but and those are kind of the two main ways that we can look at tax efficient giving. But there's lots of other unique ways, especially in Kansas. Mark, what are some other ways that people can give charitable to
Yeah.
this time of the year.
One thing that we were talking about before the show that we've heard or people in Kansas do a lot is, farmers can donate their grain directly to a charity, so they can avoid income tax on the sale and be able, to give, just pretty much giving money to a charity without paying
What?
tax there. Yeah.
What?
Yeah.
I mean, because 47 years in this industry, I know one client for sure that I have that does that. Out of all the ag producers, now there might be a whole lot more, but I think most people aren't aware of that. So I think you got to hit it again.
Yeah.
Yeah, that is extremely interesting when you, and it doesn't get much more Kansas than donating grain
Yeah.
to a charity. So I'm assuming the way that would work is they would go through the process of taking whatever amount of grain they're giving that year at market prices. They would sell it on behalf of the charity, and then the charity would get the proceeds. Or do you guys know the details of how that would work?
It's absolutely like if somebody's crop sharing. Let's say that they're farming their neighbor's ground, and when they go to the elevator and they say, 40% is for the XYZ estate and 60% is our grain, and sell that 40% or whatever they do. It would be, we out of this load, we want X% to go to our church or to, but it has to be it can't be your son's or daughter's education account. It's got to be a qualified charity. But yeah.
Okay. And for those that are listening that are not familiar with the term crop share, that's just where a lot of times, especially for farm ground, not necessarily ranching ground, but for farm ground, rent is not a cash payment, but a percentage of the crop that is grown, and that's what crop share is. That's how farmers pay rent in a lot of times with ground that's got grain on it.
So how can that help me? Well, how that can help you as an ag producer is you're paying, so to speak, at harvest. Not so to speak, but you're paying at harvest. So instead of saying, we're going to give X number of dollars a month to the church, okay, which is taking money out of the monthly budget, they can do it out of harvest and have it done for the year and move on. And if you're not doing that and you're an ag producer, that might be something you want to look at, because that's slam dunk.
Yeah, very easy. Mark, any other kind of unique ways that people can potentially give beyond kind of what we've already talked about?
I'd say the biggest thing is understanding where you can give, and maybe look into some places that you might want to give money to in the future. Like, for example, the one that keeps coming up is your church. Like, those are very obvious that a lot of people give money to. Church, your university you went to, that's not for everybody. A lot of people want to give money maybe back to their community. And so more and more we are seeing small towns and big town, big cities, whatever, they have these community foundations, which we think are a really, really important part of keeping Kansas small towns going, rich, vibrant. And so those would be another great option.
So really anywhere that has the 501c3 distribution, I guess, is tax exempt status.
Tax exempt status. It's fantastic what I want to go over a couple things here, because people need to understand the power of this. A lot of us want to help our schools, our local schools, or as Mark said, our local community. We all three live in a very small community in Kansas. Two of us grew up in small communities in Kansas, and Mark grew up up in the Topeka Seaman District, which you and I consider city. If I was in New York, we wouldn't. But at any rate, those Topeka's had a community foundation for years. Manhattan's had one. Wichita's got a huge one. Kansas City, but now small communities like Phillipsburg, Kansas, Onega, Kansas, small towns have these Caring, the one I'm familiar with is Caring Community Foundation. Silver Lake has the Silver Lake Foundation. And I'll use an example of the little town I grew up in. They needed money for a weight room at the high school. You could give your money to the Caring Community Foundation, and it could be designated to the weight room at the school. Let me help people understand. If you walk up to the school and hand them money, if you went up to the school and hand them money and say, I want it to go to the weight room, they will say, we will try to do that, but that's a board decision. Okay? By giving it to a community foundation, that money can be given to the school and designated. Don't ask me why. I don't understand that.
That's the same thing with like Kansas State. If you go to Kansas State and give money to K-State, they're going to put that money wherever you want it. If you give it to the K-State Foundation and designate it, then you know where your money is going.
Right.
Yeah.
Yeah. It's kind of odd how that works, but there's been occasions when clients of ours have wanted to help somebody, and then they were told, well, you can give it to us, but we might not use it for that. Well, that's not what that person wanted to give it for. So I thought that was unique. Let me give another example for folks. We had a client that was selling a very highly appreciated piece of property simply because they wanted to get it. They were ready to move it on to someone else, and they were going to take a gain of about $180,000, which was they're over 70 and a half. And so it was going to throw them in, or over 65, going to throw them into the IRMA. It was going to, they were going to have to pay 20% capital gain tax on it. And they gave that money to a community foundation in their community. They gave them the property. They wanted this property to go to a certain person. The foundation sold that property to those folks. They got to put money into a DAF, a $190,000 gift, and they can, they're opening up a scholarship for a child that they lost. They are giving money to their churches, and they've lived in several places during their retirement, so they can give to separate. Otherwise, they can do whatever they want with that. They have as long as they want to do it, and everything they've done is above board legal, and it was a very simple process.
That reminds me of another great thing that we've talked with other clients about before is charitable remainder trusts. Could you maybe talk a little bit about, it's similar to that situation is why I bring it up, but how could someone use a charitable remainder trust?
Okay, first of all, the cost that this client incurred to do this transaction to a charitable foundation was about $290 of trust work, by an attorney doing the trust work. A charitable remainder trust is a fantastic thing. They're very expensive. The cost is minimally about $10,000. But let's say somebody's selling a section of ground, and they have owned that section of ground for 40 years, and we all know that that's going to be a crazy gain. You can take and do a charitable gift of a portion of that, and this is all a lot of tax studying and putting numbers together. But let's say that ground is worth $1 million, and there's a $800,000 gain. Well, they can maybe put $400,000 of that into a charitable remainder trust, which means remainder trust means we're going to give this money to our church when we're gone. Okay, they're going to sell the ground to somebody that we've picked, just like I talked about earlier, and they're going to get the cash, and they're going to have that money in this charitable remainder trust. It's going to be managed, and the people that donated it are going to get around, let's say, $20,000 to $24,000 a year of income, as long as either one of them are on the planet. Okay, they get the write-off of that $400,000 up front. So the $600,000 that they receive that has a $500,000 gain on it, with a $200,000 tax liability, they basically have washed out with the Charitable Remainder Trust. So they've sold a section of ground. They're getting $20,000 a year of income for as long as one of them is alive, and they didn't have to pay taxes on the sale.
So a very complicated process, it sounds like, and that's one of those ones where there's obviously some great opportunities there, and if you're an individual that has a situation similar to that, that's the probably best advice there is get with somebody that is knowledgeable on that, and there's going to be a cost involved, but definitely want some professional help when you're doing something like that.
When we've done them for folks, the cost in it is the attorney fees, because that's a pretty deep dive, from what I understand from the attorneys. What we generally do is what's in it for us as we manage the money in the CRT.
Gotcha. Okay. Mark, any other final thoughts before we wrap up this episode?
The biggest thing I'd say is, why do people give? Like it is a great feeling. It's a great way to offset some of your tax liability. Find causes that you want to support, and make sure that as you get older, this isn't something you have to do, but find something that you want to support. If you're young, you're listening to this, or if you're getting close to retirement age, think of those things that you want to leave a legacy to, or that you would want to support as you get older.
Yeah, I think that's a great point. And for folks that are charitably inclined, there are definitely some ways that we've discussed to talk, to take advantage of some efficiencies with those.
We all see the American Cancer Society, the American Heart Association, the Red Cross, Salvation Army. We've all of our lives, those have been important parts of what we're consuming and we know about. My final comment on that would be, folks, look local. There are folks, churches, schools that, for instance, I think one of the best things I've heard of people doing in our community is someone going in and saying, what's the bill for young people that haven't been able to pay for their school lunch? Yep. There are people, I think we all, sometimes charitably we think globally, or we think nationally, or as a kid giving church missions and things like that, and that's fantastic. But I think if we look in our little small communities, there are tremendous needs where we can get tax advantages, but as Mark pointed out, the joy of giving and sharing and helping our small towns.
Very good. Well, gentlemen, thank you very much for another great episode. Hope you both have a great holiday season as well.
Same to you, Joe.
Yeah.
So once again, BobSchwartzFinancial.com is the place where you can get more information about the work that Bob and Mark do. Once again, if you're watching us on YouTube, please give us a thumbs up and subscribe. Give us a rating on one of the podcast services. And until next time, thanks and have a great day.
Thanks.
Thank you.